Welcome to the Deep Dive, where we plunge into a stack of sources to extract the most important nuggets of knowledge and insight. Today, we're embarking on a fascinating journey into the timeless world of investment wisdom, going way beyond the daily headlines. Our focus, the legendary investor Philip A. Fisher and his seminal work, Common Stocks and Uncommon Profits. Our mission today is really to unearth these enduring principles from Fisher's philosophy, and we're enriching that with the unique perspective of his son, Philip Fisher. He didn't just update his father's classic, he also wrote his own essential book, Conservative Investors Sleep Well. We want to understand not just what made Fisher successful, but the underlying insights that, are still surprisingly relevant for you, the curious learner looking for clarity in, let's face it, a complex financial world.
And that's exactly right. That's our goal.
Yeah.
Because while Philip A. Fisher's main book was written, way back in 1958, its core principles really do transcend time. We're going to explore why these approaches matter, how Fisher's own personal journey sort of shaped his groundbreaking ideas, and importantly, connect those insights to the challenges and, opportunities you face today. It's really about building a solid framework for thinking about true business value.
Okay, so with that sort of fascinating context of market evolution, let's really dive into the core of Fisher's genius, common stocks and uncommon profits. I mean, this wasn't just another investment book, was it? It was, remarkably, the very first investment book ever to hit the New York Times bestseller list. That's huge for a topic many consider, pretty dry. It really signals a big shift in how people thought about investing their money.
It truly was a paradigm shift, yeah. At its heart, the goal of investing, as Fisher saw it, is simple. Make money.
Right.
But, and this is key, he contrasted this really sharply with the traditional 19th and early 20th century method, which largely involved, betting on the business cycle, basically. Buying low during busts, selling high during booms. Fisher's genius was shifting focus, identifying relatively few companies with outstanding investment possibilities. For those multi-bagger returns, we're talking about, imagine, a $10,000 investment that could, maybe over 25, 50 years, turn into $250,000. Or even way more. That's the game he was playing.
That really changes how you look at market conditions, doesn't it? But here's where Fisher's insights get, even more compelling. He made a pretty surprising claim for his time, arguing that investment opportunities in the 1950s were actually better than in the early 20th century. And he had three key reasons. First, the evolution of corporate management. A generation before, big companies were often family-run. And there was a real risk insiders would just grab all the benefits, But by Fisher's time, management was becoming more professional, less insider dealing, and crucially, more focused on long-term growth and research.
Exactly. You've hit on a critical point. His second reason was that explosion in corporate R&D, research and development. Think about it. In 1953, private corporate R&D was about $3.7 billion. Just 3 years later, 1956, it jumped to $6.5 billion. Huge increase. But he warned, this isn't a quick win. It usually takes, 7 to 11 years from idea to actually having a significant favorable effect on earnings. And like hitting in baseball, a lot of research projects, they're bound to produce nothing profitable at all. So patience is key, and understanding failure is part of it.
Right, that R&D gamble. And speaking of bigger forces, Fisher had this critical third point about government policy, how it fundamentally changed the investment game. After 1932, both political parties started using policies, things like deficits, tax cuts, public works to fight recessions. This created what he called a built-in inflationary bias.
Inflation creeping in.
Exactly. So what does this mean for you, the investor? Basically, the value of your money and that fixed income from traditional bonds gets slowly eaten away by rising prices. Fisher pointed out, just between 1946 and 1956, the U.S. dollar lost 29% of its purchasing power. That made bonds undesirable investments for the strictly long-term holdings of the average individual investor. Okay, so it's one thing to understand what kind of companies Fisher was looking for, but how did he actually find them? This brings us to his, legendary approach. Almost investigative, his famous scuttlebutt method.
Scuttlebutt. It's much more than just, standard research. It really is an art form because it needs this level of interpersonal skill and persistence. It goes way beyond reading reports. It's about gathering info from real Main Street sources outside the company. Think about it. Who knows a company best? Competitors, vendors, customers, even university scientists, government researchers, trade association execs. But the crucial rule, the absolute key is, the inquiring investor must be able to make clear, beyond any doubt, that his source of information will never be revealed. Then he must scrupulously live up to this policy. Trust is everything to get those candid insights. He wasn't just collecting facts, he was building this whole qualitative picture. And what made Fisher an artist at this, his son points out, was that his best questions always popped out of his mind, unprepared, never having been written down, because they were the angle he picked up on the fly. He listened so deeply, then asked that perfect, incisive question based on the moment, not from some checklist.
That's fascinating. It really speaks to a kind of intuitive brilliance, doesn't it? And speaking of incisive questions, James Michaels, the former Forbes editor, shared this stunningly cunning question he heard Fisher use. He'd ask executives, "What are you doing that your competitors aren't doing yet?"
Oh, that yet is powerful.
Exactly. It reveals everything. It's designed to uncover either complacency, or they just resting on their laurels, or the opposite, genuine innovation, that relentless drive to stay ahead. A company asking itself that is rarely caught flat-footed. Okay, these insights lead us right into Fisher's 15 points to look for in a common stock. Now, he emphasized a company doesn't need a perfect score on every single point, but failure on many of them. That's a serious red flag. What becomes clear for you, the listener, is Fisher was basically building this rigorous qualitative checklist, a blueprint for what makes a truly great business, not just, financially okay. Let's look at a few key ones. Point one, market potential. A company needs sufficient market potential to make possible a sizable increase in sales for at least several years. He used Alcoa, the aluminum company of America, as an example. It grew almost 500% in value in just 10 years. Shows what a fortunate and able company can do with room to grow. And he notes, growth isn't smooth. It comes in irregular series of uneven spurts.
Yeah, building right on that. Point two looks at management determination for future development.
Yeah.
It's not just about current products. Does management actively plan for future growth? For when current lines inevitably mature, this isn't about what is, it's about management attitude, their vision. And critically, this drive needs to be guided by solid market research. Make sure R&D focuses on products that will actually be profitable, not just colorful tech that nobody wants. It's about sustainable innovation.
And then point six, profit margins. Fisher stressed it's not past margins, but future margins that matter to you, the investor. With costs always rising, how does a company keep or improve its profitability? He warned against just relying on price hikes. He mentioned the aluminum market in '56. It suddenly shifted from short supply to aggressive competition. Price hikes became tough.
Competitive pressure.
Or the copper market, where high prices eventually killed demand and brought in new supply, leading to an unbalanced situation, poor future profits. It really highlights the need to understand a company's competitive edge.
Definitely. And point seven tackles labor and personnel relations, often overlooked, but incredibly important. Fisher believed the profits from good labor relations are way far greater than the direct cost of strikes. Obvious when you think about it. Companies with great employee relations, they get higher productivity, lower turnover, more efficiency overall. He pointed to Motorola in Chicago and Texas Instruments in Dallas, both in highly unionized areas, but they succeeded without unions. Why? Because of their successful personnel policies. They genuinely convinced workers they wanted to treat them well. It's about that culture of respect.
Right. And finally, let's touch on point 14, management transparency. Fisher wanted management that talks freely to investors about its affairs when things are going well, sure, but also when troubles and disappointments occur. He knew that costly failures and unexpected delays are just inevitable in business, especially for innovative companies. How management handles setbacks openly with good judgment is often a sign of strength rather than weakness. That's a powerful point, isn't it? Turning a negative into a sign of resilience. How hard do you think it was to convince investors of that back then?
Oh, incredibly challenging. Most investors just want the good news, right? They panic at the first sign of trouble. But Fisher saw that transparency, especially in tough times, builds long-term trust. It shows a management team that's accountable, focused on fixing problems, not just spinning stories. He was looking for character, not just charisma.
Okay, great point. Now, let's pivot to some really practical advice. Fisher's 5 don'ts for investors. These are gold. First, don't buy into promotional companies, his rule. Pretty clear cut. Any company without at least 2 or 3 years of commercial operation and 1 year of operating profit is just too risky for ordinary folks. Leave those speculative ventures, those blueprints, to specialized groups who can handle that kind of risk. For you, the everyday investor, patience and a proven track record are crucial.
Absolutely. The second don't is interesting. Don't ignore a good stock just because it is traded over the counter. OTC, not listed on a major exchange like the NYSE. Fisher saw how the market changed. Less gambling than the 20s, more cash buying, and this tremendous growth in institutional buyers, pension funds, mutual funds,
Yeah.
big players. This meant many solid OTC stocks in this day were actually frequently more liquid than some listed on the American Stock Exchange. They were perfectly fine for serious investors. Don't let old labels limit you.
Good advice even today. The third one is simple, but so true. Don't buy a stock just because you like the tone of its annual report. He warned that, glossy photos, slick design, polished writing often just reflect little more than the skill of the company's public relations department
Yeah, PR spin.
in creating an impression. Rather than showing the real strength of the business or management, he's basically telling you, look past the shiny cover, dig into the actual substance.
Couldn't agree more. For his fourth, don't. Don't assume that a high price-to-earnings ratio means further growth is discounted.
Oh.
The PE ratio, right. Common metric, share price versus earnings. Fisher felt that these high-flyer stocks will frequently be found to be discounting the future much less than many investors believe. Growth might still have a long way to run. He used this great analogy. Imagine buying a share in a classmate's future earnings. If one becomes sensationally successful, its value multiplies 600 times. You wouldn't sell just because it went up a lot.
No, you'd hold on.
Exactly. You'd keep it for the long haul. He argued, many of the arguments commonly heard for selling the good ones sound equally silly.
Love that analogy. And finally, timeless advice, maybe more relevant than ever. Don't follow the crowd. Fisher saw how fads and styles in the stock market create these distortions in prices, sometimes for months, even years. He talked about the mass delusion of 1947, 1949. The financial world was terrified of a big post-WWII depression. So even with strong earnings, stocks were cheap. Then the fear lifted and boom, stocks more than doubled in price. Why? Just a tremendous psychological change. So that ability to see through some majority opinions, to find what facts are really there, that independent thinking is absolutely crucial.
Mm-hmm. And related to returns, Fisher also tackled the hullabaloo about dividends. For long-term investors aiming for maximum capital gains, he argued, dividends begin rapidly to lose the importance that many in the financial community give them.
Yeah.
That's really contrarian, right? So many people chase dividend yield.
Definitely.
But Fisher's logic was, growth companies that reinvest their earnings back into the business often produce spectacularly better capital appreciation. Your initial investment grows much more. And over 5 or 10 years, these companies often end up providing a greater dividend return on the original investment anyway, compared to high-yield stocks, because the company itself has become so much more valuable. It's about where that dollar generates the most long-term value.
That's a profound shift in focus. Wow. Okay, now let's step back a bit and try to understand the man himself behind these methods. His son, Philip Fisher, described his father as, quote, financially facile until he was pretty darned old, meaning he stayed sharp with numbers with investments late into life. But he also paints this picture of a solitary guy who just didn't like people very much, except notably his wife.
Yeah, quite a character. His frugal nature was famous. He insisted on sharing hotel rooms with his son on business trips, even when his son could easily afford his own room. And then there's that story from the Monterey Conference, classic Fisher strategic thinking. Dinner contest, predict the Dow's move for the next day. Most people guess small changes, maybe up or down a few points. Fisher Sr. puts down up 30 points, a huge improbable jump.
Why?
His logic was, if he won with a small guess, people would just say he got lucky. But if he won with a big, unlikely guess, they'd think he knew something. Well, the Dow went up 26 points. He won. Looked like a genius, not just lucky. And on a personal level, apparently very reserved. His son said he never, ever praised him directly about anything at all until he was well into his 40s. Pretty demanding.
Wow. His interest in the market started incredibly young, though. As a boy, he heard an uncle discussing stocks with his grandmother, and it opened this whole new world. Realizing he could save money and buy a share in the future profits of these huge companies. But despite this early fascination, his father, a physician, strongly discouraged him, worried it would teach gambling habits.
Interesting. Maybe that early pushback actually fueled his later rigorous, fact-based approach, made him determined to prove it wasn't gambling if done right. And his early experiences definitely shaped his philosophy. In August 1929, just before the crash, he actually predicted that the next 6 months would see the beginning of the greatest bear market in a quarter of a century. Pretty spot on.
Amazing foresight.
Yeah, but here's the kicker. Despite predicting the crash, he was nevertheless entrapped by the lure of the market. He bought what he thought were still cheap, cyclical stocks. Companies tied to the economy, like a locomotive maker, a billboard company. They got hammered in the Depression, and he lost money. That painful lesson really drove home the importance of deep qualitative analysis over just looking at seemingly low prices, even if you think you know where the market's heading.
And these personal journeys, especially the early mistakes, offer such powerful lessons. This next bit feels like a really pivotal moment for him. In the absolute depths of the Great Depression, like 1932 to 34, Fisher found what he saw as a once-in-a-lifetime opportunity, a company called Food Machinery Corporation.
Right. And his deep dive into food machinery shows why he thought it was so special even then. First, it was a world leader in its niches, had an advantage of scale, low-cost producer because it was big. Second, strong marketing position. It had locked up markets because of its critical spare parts business. Customers were kind of stuck with them. Very. Third, a superbly creative engineering or research department. They were developing really promising new product areas like the first mechanical pear peeler or a process to synthetically color oranges to make them look better. But crucially, it was the quality of the people that stood out. John D. Crummy, efficient, high moral code, a brilliant chief engineer securing patents, Paul L. Davies, strategic thinker. It wasn't just the product, it was the team.
That focus on people really shines through. Which brings us to Fisher's contrary but correct philosophy. He stressed, yeah, there are huge profits in going against the crowd, but you must be very, very sure that you are right. Conviction matters. He lived this in 1955, bought big positions in what many saw as speculative companies, Texas Instruments and Motorola. TI took off pretty quickly, but Motorola, it just fluctuated 5% to 10% below my cost for a while.
Ouch.
Yeah, a client even called Motorola that jerky. But Fisher held on, and eventually, patience had paid off here. He really walked the talk on contrarian discipline.
Absolutely. And his experiences taught him another lesson. In and out, maybe out of the money, short-term trading. After WWII, he made what he called one of the more valuable decisions of my business life, which was to confine all efforts solely to making major gains over the long run. He realized that trying to time the market, even if you get it right sometimes, the rewards were often insignificant compared to the huge gains from holding truly great companies for years and years, a fundamental difference between investing and just speculating.
Makes sense. He also shared this very personal lesson. Reaching for price, foregoing opportunity. Early on, especially during the Depression when money was tight, he found himself constantly battling for eighths and quarters on stock prices, trying to squeeze out the absolute lowest purchase price.
Penny-wise, pound foolish, maybe?
Kind of. Bruegger's told him, look, it makes very little difference whether I acquired its shares at $10 or $10.25 if you think it's going to triple or quadruple in a few years. He realized obsessing over tiny price differences was silly, given his long-term goals. The lesson for you: don't let small price haggles distract you from the big picture, the long-term value.
So true. Fisher also took away two really profound lessons from Dr. Herbert Dow, the founder of Dow Chemical. These are great. One, never promote someone who hasn't made some bad mistakes, because if you do, you are promoting someone who has never done anything.
Interesting take.
Isn't it? Fisher believed that when great companies inevitably stumble, make a mistake, the market often overreacts. It downgrades management too harshly. And that creates tremendous bargains for investors who understand that the stakes happen. The second lesson from Dow: if you can't do a thing better than others are doing it, don't do it at all. Just constantly strive for competitive superiority. Never rest. That's core to building an enduring business.
Love those. Now, a question every investor wrestles with. Stay or sell in anticipation of possible market downturns. Market timing. Fisher had a, let's say, minority view here. He said, even if the stock of a particular company seems at or near a temporary peak and that a sizable decline may stripe in the near future, I will not sell the firm's shares provided I believe that its longer-term future is sufficiently attractive. He'd only sell if management truly deteriorated or if the company's growth potential genuinely ran out. He believed in holding great companies through market storms.
So how did he actually do it? Find these growth stocks? His process was specific, initial ideas. Surprisingly, only about 15 came from his business and scientist contacts, the other 45, from a small number of men whom I had seen do outstanding work in selecting common stocks for growth, trusted sources. Then he'd use snap judgment to decide which ones were worth digging into. The real work: aggressive scuttlebutt. Gather at least 50% of the info before even thinking about contacting management.
Why wait so long?
Because knowing so much upfront meant he could ask way better, more pointed questions. And management was more likely to give a realistic answer because they knew he'd done his homework. Only in the occasional case, when I have a great amount of favorable data, would he finally reach out to the company management directly. It was this rigorous, almost backward process.
Fascinating process. And as powerful as Philip A. Fisher's original insights are, they got refined, maybe even battle-tested by his son, especially during a really tough market period. Let's turn now to Conservative Investors Sleep Well, written mid-70s, during what was the worst bear market, long period of falling prices since the Great Depression. Average stock down 70% from its 68 peak. Talk about a tough time to write about conservative investing.
Right. Seems counterintuitive, but the Sun makes this vital distinction, acting conservatively versus acting conventionally. Conventionally conservative stocks back then, things like Penn Central and Consolidated Edison, big, stable, blue-chip companies everyone thought. They turned out to be disasters for investors.
Yeah, Penn Central went bankrupt.
Exactly. True conservative investing, the Sun argues, is the approach most likely to conserve, i.e. maintain purchasing power, at a minimum of risk. It's about actually being safe, preserving your money's real value, not just following what's popular or seems safe on the surface. Those can be misleading.
Okay, so how did the son define that true conservatism? He built on his dad's points, distilling these dimensions of a conservative investment. The first dimension, managerial competence, across the board. Production or operations and service companies, marketing, research, financial controls. Proven results, not just talk. The operational foundation.
Then the second dimension, the people factor. Absolutely critical. This is the human element that drives long-term success. It needs a leader with a determined entrepreneurial personality, a competent team where people can actually delegate effectively, and crucially, fostering an environment where employees at every level believe that their company is really a good place to work. He stressed promoting from within is usually better. Having to hire an outside CEO, often a damning sign that something's wrong with the internal culture or talent pipeline.
Interesting point about outside CEOs. And the third dimension, sustained high profit margins. How do companies keep making strong profits consistently? Often through economies of scale. Think big factory, lower cost per item due to volume, simple but powerful. Also, if it's hard for competitors to enter your field, especially complex tech fields, that's a strong advantage, an economic moat.
Yeah.
And finally, customer loyalty, especially if your product is critical for the customer, but maybe a small part of their overall costs. They just keep reordering automatically and not shopping around for cheaper options. These are real differentiators.
And Philip A. Fisher, in the updated edition of his book, directly tackled the fallacy of the efficient market. This theory, says all known info is already baked into stock prices. So real bargains can't exist unless you have illegal inside info. Fisher totally rejected this. He said, if the market was truly efficient, then stock returns should not subsequently have the huge variations that they do between different companies. Some do great, some bomb. That shouldn't happen if everything's priced perfectly. This fallacy is actually what creates opportunities for investors like you who can look past the current market image and find value where others don't see it.
That makes sense. And it leads back to a basic rule. The further into the future profits will continue to grow, the higher the price-earnings ratio an investor can afford to pay. The PE ratio again. But, and this is key, remember that the actual PE ratios you see in the market come from what the financial community believes will happen, not necessarily what will happen. This mismatch often creates extreme levels of undiscounting, meaning pessimism pushes prices too low, especially in bad market times. That presents unique opportunities for the patient, discerning investor.
Exactly. And finally, let's loop back to diversification. Fisher famously said, don't overstress diversification, don't spread yourself too thin. For him, quality over quantity was key. He suggested maybe just 5 stocks for those big institutional-type growth companies, Dow, DuPont, IBM back then, for good mid-sized companies, maybe up to 10 or 12. He even suggested if you find a high-risk, high-potential stock, a C stock, and it really takes off and becomes a huge part of your portfolio, keep it. The company proved itself. It's about concentrating your money in truly outstanding companies you understand deeply, not diluting your returns across dozens of average ones.
Just incredible enduring wisdom from Philip A. Fisher, and then refined by his son. We've covered so much. The power of that deep, qualitative scuttlebutt research, the absolute importance of understanding management, the people factor driving the business, and the discipline, the patience of a long-term focused approach that ignores market fads and short-term noise. It really shows how human insight can still beat complex models sometimes.
Absolutely. And ultimately, Fisher's challenge, maybe, to you, the listener, is this. Can you cultivate that Great effort combined with ability and enriched by both judgment and vision. That combination need to find those truly fortune-producing growth stocks that everybody else is overlooking. It takes work, patience, deep qualitative digging, and, yeah, the courage to think for yourself.
So here's a final thought to leave you with. If the market, as Fisher argued, is constantly wrong in its appraisals, often blowing negatives or positives way out of proportion, what does that tell you about the power of independent facts-based thinking? Not just in investing, but maybe in all areas of your life.